Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby Kinzer.
And I am Thomas Doty.
We are the FITT Show coming to you every Thursday at 8 p.m. This is our 70th show, dope. 70. We rolling, brother. We putting the information out there where the people can get it. And we hope you are enjoying this. I want to thank everybody out there in virtual world who's tuning in this evening around the world and the USA. Remember to click on Facebook Live, click on and share button, and also click on the heart and the thumbs up button to give us traction. And if you're out there on YouTube, please subscribe to YouTube and also share. So now that we got the administrative things out of the way, just like to welcome everybody. Try to provide information that'll help people get their finances in shape. Try to put it where as a whole say where the goats can get it. You know what I'm saying? So thank you once again. Last week's show was investing principles for all times. We're trying to give different topics. So remember, we're looking to hear from you. So put in the comment box any type of information you'd like to provide for us that pertains to topics that you like for us to talk about, because we just not just going to talk about what we think we need to talk about. We want to hear from you. So please use the comment box for that. With that, thank y'all for tuning in. And once again, we got people all across the waters, across the world tuning in. So thank y'all for tuning in over there in Scotland and England this evening, because we know that means that you all are up around, what's that, 1 o'clock? Wow, in the morning. So thank you for that. Yo, let's start at the top of what our favorite subject at the top of the FITT Show is. And it's talking about the stock market update.
Man, I wish it was better news, but third quarter is about to end. And I'm glad the third quarter is about over, because this has been an ugly quarter. Just on Thursday, today, stock fell 460 points. The Dow did. And it's in a bear market, no doubt about it. It's 20% below its all-time high, which it set in January. S&P slid 2.1% on Thursday, and that's a new low for the year. And so they are once again far from the lowest level since November 2020. So the NASDAQ's even worse. Today, NASDAQ is down 2.8%. And it's worse than the Dow. And every exchange from the UK, Europe, Asia, they've all dropped sharply this year. So it's been an ugly year everywhere in regards to the stock market. And things were rolling in July, but inflation, rate hikes, bond yields, recession, war just beat us up in August and September. And so just today, they had a little drop in the jobless claims, which kind of spooked investors, because they keep thinking as long as the market is strong, the Fed's going to keep pushing interest rates up to slow things down. So it's like sometimes good news is good news and sometimes good news is bad news. And today, good news of the jobless claims not being down that much ended up being bad news. And it's so bad now that even bonds, which are usually safe havens when the markets are doing bad, but bond yields are also down. The bond funds are also down. It's just bad. Usually gold, when times are bad, is usually doing good. But even gold is down 10% this year. So cryptocurrencies, they've fallen off a cliff. They're down 60% in 2022. So it's not a good place to be in the stock market. But as we always say, we invest for the long term. This too shall pass. There's a couple of safe places you can be right now. If you're in oil stocks, you're doing okay. If you're in healthcare stocks, all except Pfizer, they're all doing okay. Chevron is the biggest winner on the Dow. It's kind of rolling. And then some of the big healthcare stocks, Merck, Amgen, United Healthcare, they're all doing real good in the Dow right after Chevron. But if we want to talk about just for the last week, as we normally do. You want to put the chart up, Bob?
Yes. Let me get it back up there for you. I had it up there. I thought you were just going to go ahead and let them see it and then.
No, I was just going to tell all the bad news. And again, it, like we always say, this too shall pass. But just for the past week, the Dow's down about 500 points. It had a big gain yesterday, but it was all offset today. That's about 2%. NASDAQ's down a couple hundred points today, or 2%. Microsoft's down $1 in the past week. Tesla's down $14. Apple, which had been hanging in pretty good through all the turmoil, is down 9 points in the last week, and Pfizer's pretty much staying flat. So, things are definitely a bear market. Don't know if it's going to end up being a recession. Kind of looks that way, but who knows? We'll see how things shake out in the next couple of weeks, and hopefully the fourth quarter will be a little better than the third quarter, because the third quarter was brutal and ugly.
Well, dope. Based on the adjustments they made on the economy and the consumer price index, they're saying this was 2 quarters or 2 months. And I think they said this was the second quarter retraction, and normally that's the definition for recession, but they don't like to say that word because that's a bad word. They usually say it after it's over for some reason, but I think it was 2 contractions in a row, and that's usually the definition of a recession. But they're not saying that. But like we always say, though, it's all about the long term, the long play. So, though, obviously, we know the market has been taking a beating, and crypto has been taking a beating too. Crypto is down about 70%. Most cryptocurrencies. Now, we know there's over 18,000 cryptocurrencies, but we usually just look at the ones as the top 10 in the market. The cryptocurrency market cap as a whole last week was at 982 billion. And this week is at 983 billion. So it's up 1 billion. Hooray. Last week, the Bitcoin was at $19,411 per Bitcoin. Today it's at $19,475 per Bitcoin. It is down today. It's up a few dollars from last week, thank God. Bitcoin is still the number one cryptocurrency out of all 18,000 or more cryptocurrencies. Last week, the market cap was at 31 billion. Remember, last year it was at 1 trillion. Today, the market cap is 373 billion. That's down considerably. Shiba Inu, which a lot of people follow, it just goes up and down. It's one of those meme cryptocurrencies. It's been holding at 0.00001, and the market cap was at 6.3 billion last week. It's up about a couple 200 million at 6.5 billion. Last week, it was at number 13. This week, Shiba Inu is up to the number 12 spot. It moved up a spot. The Dogecoin, which is back and pushed by Elon Musk, and the guy down there, the Dallas Mavericks, Mark Cuban. It was last week. It was at 5 cents. This week is at 6 cents. What a big jump! The market cap was at 7.9 billion. This week it's at 8 billion. So it went up 100 million. Last week it was ranked at number 10. It's still ranked at number 10, the Dogecoin. So that's the update on the cryptocurrency, though. Let's talk about our subject today, man. What the Federal Reserve is playing a major part in.
Yeah, this is the third consecutive 0.75 percentage point increase. It's the fifth increase in the last 6 months, and it's all part of their effort to cool runaway inflation, try to slow the economy down. And it's brought the federal funds rate to about 3 to 3.25%. That's the highest it's been since 2008. If you think back to the start of the year, the rate was basically zero. So it's been a pretty healthy increase, and it's kind of tough for people to find, it's pushing interest rates up. You have to go back to 1981 to find a 6-month period where interest rates rose more. Wow. And they were crazy. From the end of July 1980 through January 81, the federal funds rate bounced from 9% to 19%. And that was just crazy. I remember that because I had a 16% mortgage back in 1981, which was...
People think that's crazy today.
Yeah, that is crazy. But it was... I made a deal out of it. I won't go into the story, but there's a story there. But I did make a deal out of it. But it may continue. They may continue increasing, but we'll see how things go. It doesn't look like it's really slowing inflation down at this point. So there may be increases in the future.
So our topic today is rising interest rates and what are the experts doing? Though a lot of people will be asking me, why are interest rates increasing? What is the whole, what is the effect? Why is the Federal Reserve hell bent at raising these rates? And the interest rates are rising right now because inflation is surging, not just in the United States. This is globally. There are many reasons for this, including government spending, stimulus money, supply chain issues, and cheap money in the form of low interest rates until recently. Now, the effect of raising interest rates, in short, works like this. The higher the interest rate, the higher interest rates discourage people from borrowing money because it would cost them more, right? So the result is people purchase fewer goods, leading to less demand. This, in turn, slows down business growth, share prices at companies, and the economy. So in essence, the higher rates reduce economic activity and expansion. You would think, wait a minute, don't we want that? But which curbs demand, but it promotes savings. So it's always essential to know that interest rates, the interest rates on savings products like savings accounts, a certificate of deposits, and fixed income securities, they also rise in high interest rates environments. So while many experts agree that rising interest rates are needed, there is disagreement on how long it will take to get inflation back under control. So with more interest rate hikes anticipated, it's worth reviewing how they affect your finances and how the financial experts and what they say can best help you to adjust your savings, your spending, and investment strategy. Thus, a little background, because a lot of people have been asking, why are they doing this? That's a little bit, and we hope that information helps. But now we want to get into today's topic. What are the experts saying? What are they doing? What are they saying to do in this high interest rate environment?
Well, Bob, the first thing you got to do is, and we've talked about this many times, is prioritize paying off debt. That's the first thing you have to do, because the Fed's moves make it costlier to borrow. As several forms of consumer credit is tied to the federal funds rate, and that's continually going up. So it's going to continue to get stiffer as interest rates go up. Credit card rates are the highest they've been since 1996. Mortgage rates haven't been this high since 2008, and auto loans are the highest since 2012. And further hikes won't bother fixed rate car loans or fixed rate mortgages that you have. But if you carry a balance on a credit card, the rate you owe may go up. It may continue to rise as they continue to increase these short-term rates, as the Fed continues to increase these short-term rates. And so currently the average credit card is charging 18.16% according to bank rate.
Good Lord.
Yes, it's essential that you take action now and try to pay off that debt as fast as you can.
So, though, we've mentioned this before, and we can't not mention it enough, because these rising interest rates do affect credit cards. And let's just take one for example. Say you have a credit card and it's charging you 18% interest. and you just pay the minimum balance on a $2,500 credit balance, it'll take you 23 years to pay it off. 23 years.
But that's just crazy. And I don't know if people understand that if you make the minimum payment, that's how long it will take for you to pay it off. So you end up paying 3 or 4 times whatever the item was worth.
And it helps you keep from your credit lapsing, right? But they're killing you on the interest.
Oh my God.
So though, the interest you save by paying down debt is the same thing as making an investment with the same rate of return on an after-tax basis with no risk. Meaning, if your card has a 22% interest rate, it's the same as earning 22% on your investment after taxes. So if you're unable to pay down your debt quickly, moving your debt over to possibly a balance transfer credit card, with a zero interest rate for 6 to 21 months, it can ensure that you'll owe no interest, but you're still going to have an outstanding balance, and you need to pay it off before those 6 to 21 months. But that can help you if you're just a person that is really struggling and you need some time, but you're going to have to pay it off, because if you don't pay off that interest, if say they give you a grace period of 21 months, all that interest is going to charge back. That's just one option. Now, another option for easing your high interest rate debt burden can include consolidating your debt under a low rate personal loan, meaning that the personal loan is lower than the rate that you're going to pay on that credit card. There are personal loans out there. Or you can be signing up for a credit counseling service. Now, we are not big at recommending credit counseling companies, but there's a nonprofit one called the National Foundation for Credit Counseling, and they are national. You call them up, and they'll tell you the credit counseling, nonprofit credit counseling agency in your neighborhood. And it's NFCC, National Foundation for Credit Counseling. Their website is nfcc.org. Only reason why I'm recommending that, because they are a non-profit. We do not recommend people who are for profit for products. Just wanted to share that if you needed a credit counseling service, make sure you get a legit one, and they are legit.
Hey, and Bob, I'm never a proponent of home equity loans. Like you always joke about people taking home equity loans and going on vacation. But if you can get a home equity loan at a reasonable interest rate, because what you're talking about is making sure you're paying the lowest interest you can pay. So if you talked about the balance transfer option, you talked about consolidating your debt to get a lower interest rate. But if you have a home equity loan, that would be one of the ideal times to use a home equity loan to pay off credit card debt, considering that home equity loan interest rate is probably lower than you're paying on the credit card. So all we're talking about here is making sure you're paying the minimum amount of interest, the lowest interest rate you can find, to service your debt. So if it's home equity loan, if it's a balance transfer, or if it's just searching for a credit card with a lower interest rate, that's what you need to be doing now to make sure you're paying the minimum amount of interest that you can. So the offset to the interest, and with interest rates going up, you should be making more on the money you have in the bank. And so that's the other side of the coin. You're paying more in interest, but your savings should be making you more money. But there's always a catch to that, because the banks typically don't pay a very good interest rate. This is another situation where you have to shop around and find a higher interest rate. I just got something in the mail today from Robinhood they'll pay 1.5% interest on money that you have uninvested, or basically money that you have on account. And they put it in a bank. It's FDIC insured up to 250,000, like most banks are, but it's paying 1.5% interest, which doesn't seem like a lot, but it beats a zero. So if you look at what Bank of America, Chase, Wells Fargo, they're paying 0.01%. They're paying nothing. So make sure you're doing better than that, because something is always better than nothing. And you guys know me, I'm cheap as can be. I look to save pennies everywhere I can. And over the long term, it turns into dollars. And so that's just my approach. Try to minimize your interest and try to maximize your savings. So you might have to do a little homework to find a bank that's paying a decent rate. And a lot of times it's going to be internet banks or something of that sort. But it's worth the effort. It's definitely worth the effort.
Well, though there's been a shift because, like I said, it's a double-edged sword. Interest rates going up hurts debt, but interest rates going up helps savers because now, like those banks, like Bank of America and Wells Fargo, they now have all raised their savings account rates to somewhere in the market of anywhere between 2 and 3%. They're moving up rapidly with these rate increases that are going up. I saw NetWest Bank, which is paying almost 5% on CDs. Now, the thing about CDs, you have to lock it down for, a term, maybe 3 years, 5 years. But I mean, like you said, they were giving less than 1%. But that's what happens in an rising interest rate environment. The savings products, like savings accounts and things like that, it favors, and the interest rates are going up. And like you say, even though it's just 2.6 or 3%, that's better than nothing. You know what I mean? And in this environment, it's safe and it's guaranteed by the FDIC, backed by the full faith and credit of the United States government, $250,000 per category of accounts. So I want to talk next one about choose your investments wisely. Now, we always talk about the long term. Think about the long play and make sure you're not panicking. Now, if you're taking a look at your portfolio, the recent rate hiking regime, you will likely notice that your stocks and bonds don't seem to be really, really responding to higher rates favorably. The Standard & Poor's have shared about 20%, and that knows that definition means it's a bear market. So far this year, as fears have mounted among investors that the Fed's effort to slow inflation could tip the economy, like I said earlier, possibly into a recession. So now, higher interest rates lead to reduced value of existing bonds. Now, like when an investor receives a higher return on a newly issued bond, there is less demand for existing bonds with lower rates. On the plus side, although the current price is lower, if you hold onto your bond until maturity, you'll receive the full face value, and that's how you make up on the difference of newer bonds and short-term bonds getting higher interest rates and older bonds giving lower. They lower the value. An inverted relationship. Interest rates go up, bond prices go down. Now, that is not the case with mutual fund bonds and electronic trading funds. They're repriced daily, and it's based on the value of the bonds within the portfolio. And people really rarely hold bonds until maturities that are in mutual funds and ETFs. So that's another product that you can look at. The bonds traditionally are viewed less volatile and they counterbalance stock portfolio. But that haven't been much better recently because the bond prices and interest rates move in opposite directions. The bond indexes have been walloped. The Barclays, they call it the Bloomberg. A lot of people follow the Bloomberg Barclays U.S. aggregate bond index, right? And it's dropped over 13% on the year. So, really, we need to look at all the different investments in your portfolio and understand how the interest rates affect them. And, you need to, measure If you got bonds, the average duration, you need to measure a measure of the interest rate sensitivity. And generally, longer maturity bonds come with a longer duration, meaning they'll decline more in value in response to hikes in interest rates. And short-term bonds will tend to hold up better during rising rate regimes.
Okay, and another investment, one of the people that we kind of, some things we agree with from Sue Zorman,
and some things we
don't. Yeah, but one of the things we do agree with, she strongly recommends Series I bonds, and they're issued by the Treasury. They're called I bonds. They pay a fixed interest rate throughout the life of the bond, plus a rate pegged to changes in inflation. So if you buy that bond before the end of October, you'll get an interest rate of 9.62%. Now, obviously, that the part that's pegged to inflation can change, but that's what you'll get for the first 6 months or so. Few catches, things you got to be aware of. You can't redeem the bond for 12 months. So you got to wait 12 months after you purchase it if you need to redeem it. So if you need the money, you'll have to wait at least 12 months. And at that point, you'll face a penalty of 3 months interest if you cash the bond within the first 5 years of owning it. And so another way to look at it, the interest rate's about 10%. So a 3-month penalty would cost you about 25% of that. So you'd still, even if you cash it after a year and a day, you still make about over 7% interest, which, fully guaranteed by the government. It's hard to beat that now. And you got to buy the bonds directly from the Treasury website. You can only buy up to $10,000 per person. So if it's you and your spouse, you can buy $20,000, $10,000 a piece. And again, this is something that's complicated. You may need to talk to a financial planner about, just to make sure it fits what you're trying to do as far as the time horizon, being that the full maturity is 5 years. And another positive of this is you don't have to pay state taxes on I-bond interest. So it's something you should look at as an investment because of interest rates being so high.
You don't have to pay local taxes either, though. State or local.
Yeah, you just got to pay Uncle Sam. That's it.
Yeah, you don't have to pay Aunt Merlin. and though, did you say what the rate was recently on the I-bonds?
Yeah, 9.62.
Yeah, and one other feature about I-bonds, they have two rates. They have a fixed rate and a variable rate. Right now, the variable rate is at 9.62 for 6 months, and the fixed rate is 0.
Right.
But it does have two rates on it, and how it works, if inflation increases, that after 6 months, that rate might go up, though.
Oh, true, no question.
If inflation stays high. So, though, let me bring you to the bottom line, right? To all that we talked about, though. Let's talk about the bottom line here. Now, if you're wondering what happens when interest rates rise, the answer depends on which part of your portfolio you're talking about. Because rising interest rates typically make all debt more expensive, while also creating higher income for savers. The stocks and bonds and real estate may also decrease in value with higher rates. Now, you can put yourself in a defensive posture and help yourself to prepare against these bad economic times while growing and increasing your overall finances. Now, rising interest rates can negatively affect many portions of your portfolio, but there are ways to benefit from higher rates. And I just want to give you a few more things that you could possibly do to benefit from these increasing rates going up. Remember, lock in debt at fixed rates. Whenever possible, convert convertible debt into fixed rates to avoid higher payments. Increase your retirement plan contributions. Some people say, what? Why would I do that? Stock prices can be more volatile during periods of rising interest rates, we say that, but increasing your retirement plan contributions allow you to buy more shares at a lower price. And we've talked about this before. The term is called dollar cost averaging. If you buy consistently monthly, it weighs out. When you buy when the prices are low, and if they go up, and you buy when they're high. But if you buy consistently over a period of time, the peaks and valleys should balance out, and you may get more bang for your buck than trying to time when to get in and when to get out. Because most people, what they do, they get in when the market is high and they get out when the market is low, which is counterintuitive. Look for deals. As interest rates increase, some people cannot afford the rising payments. So you may get a deal, you may talk to them, and they may be willing to sell your asset at a discount to get off paying to pay off the debt. Excuse me. For instance, you may have a car and the rates are just killing you and you just can't, pay this interest. You might make a deal to sell that asset and pay that debt off and get out of it. So there's deals out there. Same thing where you have a boat or even a house. I've seen people do it. They just can't. They were in they were in arms. And you might want to get out and find a discount and be able to sell a house and pay that debt off and get out of it. And don't panic. The number one thing is don't panic. With a comprehensive financial plan, short-term fluctuations in value shouldn't even change your strategy, shouldn't even alter how you're looking at, because you got a plan and you must stick to your plan. Follow the plan to discuss any potential changes with a financial advisor. Me and Dope are big on that. We talk about that all the time. So just wanted to give you the bottom line with these rising interest rates and what a lot of the experts are saying. Once again, we pull information from different articles, especially articles like the Kiplinger, which we recommend because they give very good sound advice, and they're not really all the time trying to sell products. So that's a good thing.
Hey, Bob, and the other thing along the same line, as far as not panicking, is not to get desperate and look for. It's a real good time to fall for a scheme or somebody saying, they can get you 20% on this investment or 30% on that investment. It's a bear market. It's happened before. It's going to happen again. This too shall pass. You just got to be patient, hang in, don't panic and sell, trying to time the market because you can't. Professionals can't. So you can't. Just hang in. Things are going to turn around at some point.
So remember, in these times, there's three things that people do with their finances. They fail to plan, they lack information, or they have misinformation. And it's interesting, Dope, that you brought up about watch out for the scams, because this is when the scams come out, when markets are tight and they know people are desperate. A friend of mine came to me. He was at a wedding, met a guy. He was from DC, and they were vibing with the DC vibe. And then the guy was going to leave and said, "Look, man, got this company, man. This reverend, the sister, and her husband, and it's a multi-level marketing plan with cryptocurrency, Dope, and Forex. I don't know if y'all know about Forex, which is foreign exchange, but they made it into a multi-level marketing. Remember multi-level marketing? You get 5 people, and your 5 people get 5 people, and your 5 people get 5. In other words, it's a damn pyramid scheme, right? But all of them are not. All of them are not. But this one was based on that, Dope. And so I looked it up, and it was easy. Now, Dope, I went to Google. This company has filed for bankruptcy. Been bankrupt 4 times. They have had a cease and desist where they stopped their business in Texas, and the address P.O. box that they had in this place in Florida was a known P.O. box, a known place that had P.O. boxes of all type scammers, and then she was using her name Reverend and Faith and Finance, and they went and searched. He said he couldn't find nothing on YouTube, internet, where she was evangelizing anybody, but she was pumping the faith and finance. So, watch out, you watch out there, you all. So don't want to bring this home, my brother. Let's bring it home with the summary and takeaways. Just to recap, just to make sure you got what me and my brother here is talking about. Stick with me here as I pull it up.
Yeah, and the first one, as always, is prioritize paying off debt. And we don't mean to beat up the folks who needed debt to get out of a bad situation, but no matter how you got there, just work on paying it off. Try to minimize what you're paying in interest. Look for other opportunities. Talk to the people you owe. Some people may take a payoff that's less than the amount you owe. You just have to be careful, because if you do that, that amount is taxable, which is crazy, but it is. But just work on minimizing the amount of debt you pay.
Up the interest rate on you're getting on cash in the bank. Like we said, interest rates going up. They go up on savings accounts. So, shop around. Make sure they have that FDIC in the window where it's insured by the good faith of the United States government. And a little tip, these online banks that don't have brick and mortar, meaning they don't have actual branches or offices go in, but they're online, they are usually the financial institutions that give you a better rate on your savings account, money markets, and CDs, or fixed products, securities, because they don't have brick and mortar. But make sure, if they're online, that they're insured by the FDIC.
Okay, next, choose your investments wisely. And that includes diversifying, rebalancing, looking at things that do well in tough times, and watch out for the get-rich-quick scheme. Choose your investments wisely.
Stay on top of your game. That's our final message. Stay on top of your game. If you need financial advice, seek financial advice. And it doesn't always have to be, we prefer people who are certified or registered or have a fiduciary responsibility by law. That way they're not going to be shady, and you can have recourse. But stay on top of your game. Look at your portfolio, and if you need to make some adjustments, make the adjustments. If you don't, stay where you are, but don't panic. Don't panic, and stick to your plan. We always say that. Stick to your plan, and as long as you do that, and sometimes you got to, we make adjustments to our plan. That's a fact too, but don't be afraid to, but just stay the course. Don't panic, and trust me, it'll all work out in the long term, because that's what me and Dope believe in. We believe in the long play, but stay on top of your game. So, Dope, here we come to the end of another wonderful show. We hope we helped somebody out there with the information today. We know it's a lot sometimes, and if y'all have questions, please put it in the comment box. Or if you have comments, or if you have some topics you want us to talk about, please put them in the comment box. And I'd like to give a shout out, like I always do. Man, Dope, my wonderful sisters are always supporting me. Hey, Nolia and Linda, thank you so much for being out there. My little brother, Carl Chapman. Not that he's little, but that he's younger than me. And what's up, Garnett? How you doing,
Hey, Garnett.
Thank you. She said, oh, my God, the scams are ridiculous. And Modestine came in. I saw you trying to sneak in there late, Modestine, but I know how you are. You always get in there, girl. So thank you for checking us out. And that's everybody, Dope. I'd like to thank everybody once again for tuning in across the waters. We're here every Thursday, 8 p.m., the FITT Show. Financial information for today and tomorrow. Have a wonderful rest of the week, you all, and may peace be with you.